Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorgen, and as always, I'm here with Paul. And Paul, we've got to take a look, especially last week, the amount of volatility that's going on in the financial sectors as well as the general economy. Now, I want to start this out by throwing out a name that hardly anybody has heard of, but it could have some detrimental influences to not just the US, Europe, but the entire global financial system. And I'm talking about a name that our friend Dario has been posting recently, and that's Norinchukin Bank. And if it implodes, what it's going to do for Japan, for the carry trade, for the global financial system. Paul, as always, I want to thank you for being a part of this discussion. And although we're not going to focus completely on Japan, we've got to definitely talk about what's going on in the US and Europe.
Yes, absolutely. And thanks for joining as well, Ken. Always a pleasure. So, I guess if you want to start talking about the bank and what you've unearthed in that regard, and maybe I will just make some reference to the whole carry trade. I'm not going to go into masses of detail because it'll bore the pants off people, but just to highlight why there is some significance to it now.
Yeah, obviously this is the start of a new market week, but last week there was a lot of volatility that was overshadowed by pretty much what was going on with geopolitical events, Zelensky, Ukraine, etc. But in Japan, they saw the uh, Japanese yen that was falling against the dollar down below 150 to 149 to 148. And as part of the carry trade that has really significantly returned ever since, well, probably the last 18 months, not quite going back to the pandemic, but it's really starting to have effect on Japanese banks. And where they used to say that when the US sneezed, the rest of the world caught a cold. Well, now it's starting to happen that it's going the opposite way. And some of these major banks that have been especially um, putting capital into Europe, West Asia, the United States, they definitely will have an influence. And I think Norinchukin Bank, although I haven't myself done a great deal of research into it, it seems to be one of the key focal points, equivalent to, say, another American bank, and I'll use that on purpose, that is reported to have $600 billion worth of derivatives and MBS, CDOs. And of course, everything is so interconnected and intertied that once one domino starts to fall, we could start seeing that completely go across the board into Europe and the United States.
Yeah, absolutely. And I think it's worth mentioning the carry trade in a very broad sense. We're not going to put specific data to this because it doesn't translate too well on this kind of podcast anyway. But anyone who knows the yen carry trade, you borrow so much yen at whatever price, you convert it to US dollars, and then you invest in US treasuries. Now, if you look at the spread currently, you may argue because of the yield on US treasuries, it's quite attractive. But here's where the problem is. We're now finding that if you want to actually do this, you are now seeing a huge increase in funding costs. And therefore, this starts to obviously have a significant problem where, if you look at potentially the sort of asset side of things and the liabilities, then obviously you're going to start risking having mark to market losses. But the problem is, if you look at the asset value of things and the liability on in terms of what you initially borrowed in yen, then you can literally end up underwater on both sides of this deal. And therefore, you're in a situation where you can't exit because you'd have to realize losses on your initial investment. So your position's underwater, but you equally can't hold because your funding costs are rising, the spread is narrowing, and therefore, your position starts to weaken. And if you take simple example of this, but then extrapolate it across, well, who knows what the actual position is, maybe trillions, then the argument is, and then it becomes a systemic problem. So as I say, if you extrapolate a single trade, then you start to look at what banks and funds, the exposure they may have. And basically the losses can risk exceeding their capital buffers, so you can't exit. And of course, if trades unwind, then you're going to end up in situations where you could have the risk of having to force treasury sales. You get bond market dysfunction. The yields start spiking. There's no liquidity. And then it becomes this cascading effect with more and more positions becoming underwater, for selling, etc., etc. And this potentially has far greater ramifications than just the carry trades, and because of the contagion effect in banks, but also, all the problems of the structural issues that exist in US Treasuries, US Treasury market, the enormous amounts of treasuries that need refinancing in 2025. So, if an institution, whatever it may be, starts to have problems, the cascading effect means other institutions have to start to have problems. Then you start to get systemic problems. And the potential last thing is that triggers a wider crisis in the financial system. Now, we're not saying that will happen, but we're saying the risk is growing and why that might be the case. And that can engulf whatever financial institutions are involved in this. There are many, no doubt, because at one time it was easy money. It's not so easy money now. It's increasingly problematic. And if you're in a trade you can't get out of, but you don't want to stay in it, eventually, something has to give, and that can set off a chain reaction, and then you might potentially have major problems.
Yeah, in many ways, obviously things like the carry trade or currency arbitrage is extraordinarily dry stuff. But it's really important when you take a look at how things have increased over time. If we want to think about different events, there's obviously 2001. There's also 2008. Now all of a sudden we have the pandemic, but really that masked a lot of what was potentially going to be an explosion in the financial system before they started doing the global lockdowns. The important thing is you take a look, what has Japan been doing? They realized after 40 years, they cannot sit there at zero interest rate policy. So they have to start, they've been raising rates slowly, and it hadn't been a great deal. But when the government owns pretty much all the bonds, or at least half the stock markets and half the bonds, and they've engineered the economy completely under the auspices of the central bank, any small little thing, it's the butterfly effect. And that's exactly what raising interest rates in Japan for the first time in 30, 40 years has done. And, when you have nearly $1 trillion, if not more, I should say, trillions heading towards quadrillions all across the entire global financial system, all these derivatives stacked to punch each other, one little tiny change, whether it's the carry trade currency level going below 150 yen to the dollar. If that happens, boom, all of a sudden you've got a 3 to 4% margin call. And that, of course, you saw this, and I think it's important because it's not just the currencies or the bonds. I think this is something that we saw last week when all the cryptos across the whole spectrum started dumping off 4, 5, 6, even 10%. Usually, when that happens, of course, they're all tied to a margin call of some sort, whether it's the equities, whether it's derivatives, or the like. And so, things like the carry trade, things like the derivatives, things like crypto, they have become so intermeshed. We see this, of course, with paper gold trading. Whenever there's a margin call or equities need a boost, we see a huge dumping into the paper commodities markets. So all these things are intertwined amongst each other, and one little fail at one little point in any pretty much security or asset class across the board will have a sweeping effect. You know, even something that some of the stocks, the Magnificent Seven, everyone is so pushed into these small group of stocks. That's where the majority of the money is. If you start seeing one or two people start to sell and get out, it'll start a trickle effect. If you get a bad report, then you'll start seeing a sell-off, and that sell-off usually begins in Asia and then into Europe. And by the time the US gets on board, well, you know, early morning trading, you're already down 5, 10%. So things are so intertwined that a small little change is going to affect major things, especially when most of the economic data that's being put out by the US, by Japan, by Europe has been, I don't want to say manipulated, but it's been maneuvered and massaged to the point that it's not the real data. And when you start seeing real things happen, like we're going to talk about with housing in the US, like we're talking about with GDP, when you see the real data start to come out, people are, especially Wall Street, are like, oh my God, where'd this come from?
Yeah, absolutely. So where do you want to start with the housing market first?
Yeah, there's some real interesting information that came out just last week. I think nobody's really looking at it. It just hit upon it like a ton of bricks. And it's definitely the housing. Let me find one important thing here.
Well, this
Uh,
related to, I'll just fill in while you find it. This
okay.
relates to, I think it Freddie Mac data or was it Fannie Mae data, which is indicative of stresses in the housing sector. Everyone knows what the role they played in the 2008 financial crisis, which relates not entirely, but significantly towards the housing market, subprime, etc. And the data indicates weaknesses in excess of what we saw at any point during the financial crisis, the Western financial crisis, as it should be called. And for me, you know, when the data is weaker than what we saw during the financial crisis, you have to take note of this and realize that there are serious problems in the US housing market. And the issue is what banks have exposure to this, and how excuse me, significant is that, and does that risk alone in the housing sector causing a major bank to fail potentially? And then, of course, the contagion effects kicks in again, because as we've always said, they never fixed anything in 2008. They just band-aided it, pretended it wasn't a problem. And the structural problems in commercial real estate as well, we've discussed that, remain significant problems.
I think as a whole, interestingly enough, if you take a look at the DC, Virginia, Maryland area, as a lot of federal workers are suddenly given the axe, given their pink slip, the massive amount of homes, residential homes that are up for sale, exploded in the last week. That's indicative of just, of course, that area. But take a look at what has happened since we brought inflation into the U.S. economy for the first time, probably going back to the early 1980s of any real relevance. The importance is that you not just have home prices at all-time highs. You have mortgage rates not seen in about 20, 25 years. You have insurance costs because of inflation that are double what they were in 2008. You have the cost of home repairs and maintenance that is skyrocketing. And then, of course, since a lot of localities are losing money in their budgets, whether it's Illinois, Chicago and Illinois, California as a whole, property taxes are being raised. So it is almost becoming impossible to own a home unless you were able to buy on the cheap and have a massive amount of equity and a low mortgage rate. But even then, it's getting very difficult to try to afford to keep your home, as well as, God forbid, you want to sell it. There's just no buyers out there.
Yeah, and that's increasingly becoming a problem in the US housing market. It's not exclusively a US problem, but the defaults are rising. And I'd say when the data supports the perspective that things are, to all intents and purposes, worse than during the Western financial crisis, you then can't help but say, how's this not got greater coverage? I mean, yes, there is discussion in on social media, but this should be major headlines. But of course, they don't want those major headlines to be seen because of the fragility that exists in the financial system. So, that's just another example where, and we've spoken about these problems in the housing market, commercial real estate included, for quite a significant period of time. And it looks like these stresses and strains are building up in the financial markets to do with housing and in retail sense, but also commercial real estate. And judging by the profile, I think this was to do with defaults. And therefore, if the default rate is rising sharply, this is indicative of broader problems that exist in the real economy, where we're told everything's fine. Although I think the Trump administration is taking a more nuanced perspective of that now and starting to change the tone slightly. And something Paul and I discussed earlier on today was, is the US quite happy at this point for Besson and Trump for the markets to crash, because then they can blame it on Biden? And Besson did make the point, well, it'll become Trump's economy in 6 to 12 months. So if it's then Trump's economy, then it crashing down is not really good optics. But if something happens before then, and I'm not suggesting they're going to deliberately crash it, but if there was a crash or a correction, they can then blame the Biden administration. But if it drags on too long, there's no way they can blame them, obviously.
Yeah, and go back to 2008. That was obviously the election year. Barack Obama took over in 2009. For the first entire year, Barack Obama should have received zero blame for what took place during the Bush years, leading up to the bubbles created. So even if you dislike a given president or political party, the reality is that the first year, even the first year and a half, especially since that was such a great depressionary type of scenario in 2008, 2009, he shouldn't get the blame. It's going to be coming out of. Now, what decisions were made? The decisions were made is that the Federal Reserve would pretty much take on all monetary and pretty much a lot of fiscal policy and create QE to infinity over time, and create new bubbles, but financialize the entire system. Well, now that blame can go on to all the presidents, including up to a point President Trump during his first term. But I think those chickens are coming home to roost. And the important thing to do is to, I guess, what you can is try to prepare the country for the reality of these bubbles collapsing. To give an example of just how big the bubble is, as well above 2008, getting back to housing real quick, the Case-Shiller National Housing Index gave a snapshot. And in 2007, where the peak of the housing bubble was, their rating was at 184. Then the bubble burst in 2011. It had fallen down to 136. I remember this because a home that was selling for $275,000, my dad was able to get in 2009 after a 40% crash, collapse. He was able to get it for, say $97,000. That's just an example. Then, of course, QE came in 2012, has gone through the roof, and the housing bubble now, where it was 184 at the peak in 2007, it's at 327 right now. It's nearly double. So if 4 million people lost their homes in default, and they had to do a bailout, what are they going to do now? Are we talking 10 to 30 million people are potentially to lose their homes at a time when inflation is just going to get worse? But on that flip side, we could start seeing a little bit of deflation take place if they allow it. And that, to me, is one of the more necessary things. I think that if Bessent is smart and he's hinted at it a little bit, Trump understands it as part of bankruptcies. If they allow deflation to hit and allow this toxic debt and are willing to let some of the financial institutions and money managers fail like they should have done in 2008, then we've got the potential to have a foundation to regrow on. If they do another bailout type scenario, I think, like Japan, the West is toast.
Well, yeah, it's interesting, though, just to pick up on some of the comments that come out. There's a person called Michael Barr who's stepping down from his role as vice chair for supervision, the Fed. He's going to remain on the board of governors. He came out and said regulators need to stay vigilant about risks to the financial system. He said, emphasized things like the non-bank sector, while maintaining the need to obviously look at the importance of the credibility of stress tests and supervision, and that capital requirements should be aligned with risks. He actually said we need to be humble about our ability to predict shocks in the financial system. Now, you don't make those kind of comments unless you actually think potentially there's a problem, and it's not a problem that's a year or whatever down the line. It's something that potentially, and we have to stress that, is maybe imminent, not necessarily the correct word, but something that is on the horizon. It's interesting as well, the Dutch central bank governor, whose name's Klaas Knot, came out and warned about the risks posed by deregulation in the banking sector, saying that financial regulations need to maintain global economic stability. Yes, there needs to be simplification of some of the rules, but you don't want it to lead to broader regulatory problems. And this comes because there's clearly a feeling in Wall Street, well, we can have deregulation. What's the problem? Well, there are problems because of broader issues in the financial system, in equity markets, because there's no doubt stock markets are extremely bloated. That doesn't mean they're going to collapse tomorrow, but they're extremely risky. I think people think, well, it doesn't matter because everyone will get bailed out. There's way too much leverage and risk-taking in markets, even governments. And it's very clear that suddenly everyone's now realizing, although they should have realized it years ago, that they kept zero interest rates for far, far too long. There's also spending deficits, and Paul and I talked about that, so I don't really want to repeat that, but it's the idea we're going to resolve those problems is rather farcical, or to do it easily. And there is, already arguments to say in reality Western nations are in recession. Well, there are even people are talking about that. I think already people are starting to realize that AI is a totally overvalued, bloated sector. Its potential in it is being grossly exaggerated. I mean, there's also concerns about the fact that that will lead to company valuations being far too high, and obviously there's a lot of companies associated with that, including potentially chip companies is one example. So there is broader concerns. It might not necessarily make the headlines. People might not necessarily attribute them as being to the extent they are a problem, but there's no doubt that we're starting to see sort of issues and concerns about what Trump's policy decisions will mean in reality. There's no doubt equity markets got a heck of a boost after Trump was elected, as opposed to Trump 1.0 when the markets thought it was the end of the world. But, it's so therefore all this uncertainty adds to concerns. And it's interesting that Diamond came out, I think it was in January, said asset prices are inflated. And you need I think he said something like good outcomes to justify these prices. That's a pretty damning statement. I mean, and no doubt the broad consensus is, well, tariffs and budget cuts is something that can work well. We talked about that previously, and I think it's not possible to juggle that many plates, as it were, and one of them doesn't smash, if they're trying to get them all spinning at the same time. So economic data can say one thing, but reality is quite different. And therefore, the question is, as it's always been the case, at what point does reality become so great that you can't hide it? And then no one can deny it, because everybody's trying to deny it, pretend there's always going to be a positive outcome from this, when clearly all the data supports to the contrary. The real data, not fictitious financialization data that doesn't support the reality. So financialization says the German economy is great because the DAX is at an all-time high, where in reality, the German economy is cratering, as we know.
Yeah, and if things get get worse, historically, nations that have been unable to deal with their own financial crashes or collapses, depending on what level it is, and as their people rise up in revolt, as we're seeing right now in many places in Europe, the unfortunate thing is in the past is they look for war. And you have to wonder, we're not going to, obviously, we've dwelt on this a number of times over the weekend, but is potentially what we're seeing in Europe, where they're coming lockstep with Zelensky to offer all this military and monetary support. Is this really a consequence of the fact that they have these financial problems, these economic problems, and they have the inability really to deal with it?
Well, actually, Ken, it's interesting you mention that. I've looked at the detail. It's hot air. It's meaningless. Doesn't mean anything. This is back to the absolute crass stupidity of people in Europe and elsewhere in the West. They have no grip on the reality of anything. And so in that sense, it's not, I know history can give example. We live in a world, we don't have statesmen anymore, anyone who's remotely capable in the West of making decisions. They're just jumping in because for very different reasons. They don't want war because they're all talking. And then the backstop is, so America, what are you going to do? Are you going to backstop us? And this relates not to the current war. It relates to when the war's over. So in that regard, it's not something that we need to worry about.
Exactly. And in the end, you know what we've talked about since the beginning of the channel and for a number of years, the world is rushing headlong towards multipolarity. And what we could be seeing in many different aspects, financial, economic, geopolitical, political, etc., is the final breakdown of the unipolar world, the end of colonialism going back 500 years, and the birth pangs of the West having to realize that they're no longer the ones in absolute power, and that they're going to have to modify and change and evolve for the world that is opening up. I think that's probably a good time to call it there, indeed. Paul.
Yeah.
Paul, as always, thank you very much for all of your insight and for being a part of this great discussion.
Yes, and likewise.
And to everybody here at the Sirius Report community, thank you for all of your support. Don't forget to like, share, subscribe, and comment. Send this out to anybody you think it might be important to. And until the next time we get together, have a great day.